Good evening, everyone, and warm welcome to all the viewers of the webinar held by EAC of the ICI on recent EAC opinions under India's framework. Myself, Parul Gupta, Secretary Expert Advisory Committee, and today I am joined by Chairman Expert Advisory Committee and our immediate past President ICI, CA Dr. Devashish Mitra ji, and our speakers for the today's webinar, namely CA Himanshu Krishnadwala ji, CA Santosh Malarji, and moderator for today's webinar, CA Raghavendra Goyalji, who have graciously agreed to be the panelists and speakers for today's webinar. Thank you all, and I welcome all of you. Now I request our chairman, Expert Advisory Committee, and immediate past president, sir, to express the opening remarks. Thank you, sir.
Thank you very much. Parul Gupta ji is the Secretary of the Expert Advisory Committee. The three panelists for today, Himanshu Krishnawala ji, Santosh Mallar ji, and Raghavendra Goyal ji. And to all the viewers, a very, very good evening to all of you. You can see me smiling a bit because, see, I'm very happy that we are having this 7th webcast. When we started off this whole concept of webcast this year, and this was started off this year, we were told that who is going to be interested in compendium of opinions? Who is going to be interested in the opinions that you give, right? And will enough people come and attend your program? And we started off with a bit of uncertainty, but as we went ahead, we found that the response that we got for this was overwhelming. And you see, now there is a request that we should have physical programs, which we are trying to do. Maybe next year we shall do it this year. Maybe after the new president takes over, we shall do the physical programs also. This is our 7th one, and Expert Advisory Committee, not very well known earlier, but now it is totally in the not very much in the backstage. Formed way back in 1975. And I was just talking to the Secretary of Expert Advisory Committee and telling her that, look, I think we were formed even before Accounting Standards Board was formed. Accounting Standards Board was formed way back in 1977. Expert Advisory Committee was formed in 1975. And let me tell you, since then, this committee has been issuing opinions. In the initial stages, the opinions were based on the AS, that is the accounting standards under the Companies Accounting Standard Rules 2006. And as Ind AS came into play in 2015, hence thereafter, most of the opinions have been based on Ind AS. And of course, you see, today I think there are 2 queries which also deal with the Schedule 3 to the Companies Act. Since 1975, this committee has come a long way. We have issued more than 1,600 opinions. This year itself, tomorrow, we hope to create history in the sense that we have issued 48 opinions till now. Parul Gupta found out that the highest number of opinions given in 1 year has been 53, in the year 2014-15. We hope tomorrow, with the help of everybody, that we shall cross that figure of 53 and make it 54. Tomorrow we have a meeting, and if you cannot make it tomorrow, we shall adjourn the meeting and try to do it, by the end of this month. So, we are always trying to create, history. And the way it is, and just now, the secretary was telling me that, sir, we are now having it's so many queries are coming. Raining of queries. What has happened is this, because now the time that we take to give opinions has been shortened to a great extent. Mr. Goyal has been there with us. He will bear testimony to whatever we say. We are, trying to give the opinion as quickly as possible. And at the same time, mind you, if there is a dissent in the committee, we don't go ahead. We refer the matter to Accounting Standard Board, sometime also to International Accounting Standards Board, seeking their opinion. In one matter, we have referred the matter to International Accounting Standards Board also, because there was only 1 or 2 dissent in the committee, and we said that let us refer the matter. We want unanimity. in the committee when we give our opinions. And the committee has been doing so well. I hope you have gone through the compendium of opinions. We have got 42 volumes of those. Have a look at them. You'll find it is a storehouse of information. When I'm a bit of a senior as a chartered accountant, passed out way back in 1987. So when I look at it, I see the compendium of opinions in the hard copy. But then, if you want to have if you are not very accustomed to hard copy, we have a search engine. Take full advantage of the search engine that we have and go for the opinions that we have. And then, whenever you're looking at the Chartered Accountant magazine, when you're flipping through the pages, have a look of the opinion of expert advisory committee that is carried there. The president was telling me that, sir, this time, for us to select which opinion to carry has become difficult because so many opinions are being given. So we are trying our best to be as quick as possible to deliver in the shortest period of time and to deliver quality. Today, we have, but nowadays everything relates to Ind AS, whatever we have. Today, I believe that we have something on leases, Ind AS 116. We have something on applicability of Ind AS 108. Then we have two queries on Schedule 3. Schedule 3 has three divisions. Division 1, which relates to non-Ind AS, Division 2, which relates to Ind AS, and Division 3, which relates to NBFCs. So, and on all these three divisions, the Institute has issued guidance note. So those of us who have some kind of difficulty, understanding these three divisions, I would strongly recommend that you go through the guidance note issued by the Institute on all these three divisions. The Institute has made, such has been the treasure hope of learning, that the Institute has created. The digital learning hub that we have a look at that. It's fantastic. You'll find so much to refer to, so much to learn from the digital learning hub, right? I will not speak much more except to wish all of you a very happy learning. Three immensely learned professionals with us, and I have no doubt that you will find the deliberations not only enlightening but also interesting and enjoyable. And those two, enjoyable and interesting, are also very important for us. And with those, we try to see that more people smile when you make a presentation, the better it is. That means we are touching the hearts of people. So once more, from the Expert Advisory Committee, welcome to this 7th webcast of the Compendium of Opinions. 6 opinions taken today, and I'm sure you will enjoy the session. Thank you very much. Parul Gupta, up to you.
Thank you, sir. Now I will give brief introduction about our distinguished panelists and moderator. First of all, our first panelist, C. Himanshu Krishnad Balaji. He has a professional experience of more than 35 years, and currently he represents one of the leading chartered accountancy firm, having presence all across India and overseas. He is involved in audit of large corporates, Ind AS implementation, investigations, due diligence assignments, and conversion of financial statements from IGAAP to IFRS or US GAAPs. He has been corporate member and special invitee in various committees of ICI like Expert Advisory Committee, Accounting Standards Board, Ind AS Implementation Committee, Research Committee, and Corporate Laws Committee. He is also member of various committees and board of ICI like Financial Review Report Board, Audit and Assurance Standard Board, etc., and is also co-author of various books on accountancy and financial management. Thank you, sir, for joining us today. Now, our second panelist, CF Santosh Malarji. He has over 20 years of professional experience in accountancy advisory services and audit and assurance, including in large audit firms. He has extensively worked on IFRS or Ind AS audit and conversion engagements for several large companies in India as well as internationally across diverse industries. He has also closely worked with the International Accounting Standards Board on IFRS standard setting projects. Currently, he is contributing EAC Expert Advisory Committee in various capacity. He has also been serving as Special YT on ICI's Accounting Standards Board and has been part of several technical study groups of the ICI. He has also authored various books and media articles on accounting. Thank you, sir, for joining us today. Now, our moderator of today's webinar, CA Raghavendra Goyalji, he represents one of the leading chartered accountancy firm of Delhi NCR and has a vast experience of central statutory audit of banks and listed entities, forensic audits, and consultancy on various accounting principles. At present, he is Special YT and Expert Advisory Committee of the ICI. Thank you, sir, for joining us. And now I hand over the session to CA Raghavendra Goyalji. Over to you, sir. Thank
you. Thank you so much, Parul ma'am. At the outset, I would like to thank our very dynamic chairman of Expert Advisory Committee, immediate President Sri Debashish Mitra sir, who has been very active even after demitting his office as president. He has made sure to disseminate knowledge and to improve the quality of work that we chartered accountants are doing. This is one of the initiative in the said regard wherein regular webinars for all of us. The webinars have a purpose of disseminating the knowledge so that the function that the members are from this side of the industry or from the sectors, those are met in full. Most of the industry representatives are taking it in a right spirit because it is helping them in improving the quality of work and the quality of the reporting that is being presented to the various stakeholders. Moving on to today's webinar and moving on to first opinion which we are taking today. First opinion is similar leasehold assets held by parent and subsidiary company with different functional currencies and consolidation thereof under Ind AS framework. So as you can all see on your screen, there would be a facts of case which would come. I would just go through the facts of the case. Then our expert team member would go through in detail what were analyzed in finalizing the opinion and what is the final outcome of the opinion. So in this particular case, the facts goes as under. There is a public limited company which is in the business of exploration and production of oil and gas carbon related activities outside India. The functional currency of Child Limited is assessed at US dollar in accordance with the provisions of the Indian accounting standards. It presents its financial statement in presentation currency, which is Indian rupee. The parent company of Child Limited, which is in the business of exploration and production of oil and gas and other hydrocarbon related activity, prepares and presents its financial statements in its financial currency, which is INR. Child Limited and Parent Limited acquired adjacent pieces of land on perpetual lease in December 2003. The acquisition value of leasehold land was same, i.e. INR 200 crore for both the companies. The upfront premium and yearly lease rentals for the respective pieces of land acquired by both the companies are also same. The departure, however, lies in the fact that for parent company, the transaction was in its functional currency. But for Child Limited, the transaction was a foreign currency transaction, since for Child Limited, INR is a foreign currency. In accordance with the provisions of Ind AS 116 and Ind AS 21, the company recognized and subsequently carries the leasehold land at historical cost, applying cost method as determined in its functional currency, which is USD. The auditor has also pointed out in the consolidation, while consolidating the financial statements of Parent Limited, that the correct picture is not presented as two same kind of assets, same acquisition value, same parcel of land of Parent Limited and Child Limited at the same time at the original cost are now presenting at different carrying values due to change in the functional currency. Therefore, in the consolidation, appropriate adjustment should be made in order to reflect the value of leasehold land of Child Limited at its original INR value, so that the acquisition date instead of INR should be correctly applied. Now, the query which was asked from the board was as under. First was in case of non-monetary item where the transaction currency is same as presentation currency, but is different from functional currency, translation of such non-monetary item first from transaction currency to functional currency at transaction date, and then from functional currency to presentation currency again at reporting date is required as per Ind AS provisions. In light of the provisions of Ind AS 116 and Ind AS 21, the company has correctly accounted for its part of leasehold land in its financial statements and has adequately disclosed in respect of same. Whether any further disclosures are required by the relevant Ind AS in the regard. And last, any adjustments are required to be made in the consolidated financial statement of parent limited for presenting the value of leasehold land of child limited at its original acquisition value to remove the effect of exchange rate differences arising due to translation of functional currency difference. So this was the query which was put to the board. Now I would request our expert CA Himanshu ji to kindly dwell upon the query and enlighten the audience about. Himanshu sir, you are on mute. Kindly unmute yourself.
Yeah, good evening to all of you, and thank you, Raghvendra ji, for the stating the facts of the case. Thank you, Parul, and good evening to the chairman of the committee and Santosh and others who are on the call. Taking this particular query, the facts which have been stated by Raghvendra, I think the issue is basically on Ind AS 21, which is dealing on foreign exchange differences. And to deal with that, Ind AS allows an entity to first decide what is your functional currency and what is the presentation currency. So in this case, the parent has the functional currency and presentation currency, which is both INR. However, the subsidiary, which is the child limited, has for some reason chosen functional currency as US dollars. However, since it is ultimately going to be consolidated with the parent, which is INR, the presentation currency for the subsidiary also would become INR. So the facts are something very typical that the subsidiary has a functional currency of US dollars. Presentation currency is INR, whereas my parent has both functional as well as presentation currency at INR. Now, the first question therefore is, while preparing the standalone financial statements, how will the subsidiary deal with this particular situation? Having dealt with in that situation in the standalone, what will then happen on consolidation? And finally, what are the related disclosures, both in the standalone as well as the consolidated financial statements? When it comes to dealing with this aspect in the subsidiaries accounts, the first thing to be looked at is whether that particular item is a monetary item or a non-monetary item. Now, clearly, this is something which is an asset which is held by the company. Earlier, it was following Ind AS 16. When 116 got implemented, it started considering that as a right of use asset. So clearly, it's a non-monetary item because there is an absence or any right to receive any money directly from that particular asset. So it's a non-monetary item. So the first thing what will be concluded by the subsidiary is that it's a non-monetary item. Having concluded that, how do I do the reporting of the non-monetary item when I acquire it and when I prepare my financial statements? On acquisition, clearly it is the rate at which I have acquired, I would account for it. When it comes to the reporting period, the end of the reporting period, the non-monetary items are measured in terms of historical cost and translated at the date of transaction. However, when I present it or translate it to my presentation currency, which in the case of the subsidiary would mean that I take it from dollars to rupees, then it has to be taken at a rate which is the closing rate of the date of the balance sheet. Now, this is clearly something only if my functional currency and the presentation currencies are different. In this case, since it is different, though I will record initially everything at the date of transaction, when I am preparing my balance sheet on the presentation date, I will take the rate which is the closing rate on the date of that particular balance sheet. The differences will go to a translation reserve or something appropriate which can be termed by that particular company which is there. So The conclusion, therefore, would be something like this. If the presentation currency is different from functional currency, all assets and liabilities, irrespective of whether they are monetary or monetary, they would need to be converted at the closing rate. So Child Limited will therefore restate its ROU and treat it as part of the INR using the closing rate, which would arise with some differences from the original acquisition. Now, when it comes to preparing consolidated financial statements, the principle to be followed is Ind AS 110, Ind AS 110. Now, Ind AS 110 clearly only lays down that when you are doing a consolidation, I have to follow all normal consolidation process, and which we understand it as a line by line consolidation. I only eliminate my intra-group balances and intra-group transactions of a subsidiary. I'm not allowed to restate any translation differences in a subsidiary when I do a consolidation. In simple words, it is a mere arithmetic which you are doing, that I add up all the line by line balances. I only eliminate intercompany transactions and intercompany or intra-group balances which are there. Now, because of this provision of Ind AS 110, there could be a dichotomy saying that my parent company has the same asset which continues at a same value because my functional and presentation is same in the parent company. But when I am consolidating my subsidiary, because its functional currency is different, and on consolidation, I am not allowed to eliminate that particular difference which is there. There would be a difference in the figure of the same asset which is held by the parent and which is held by the subsidiary in the consolidated financial statements. But that would be the correct thing to do because 110, in fact, wants you to follow that line by line consolidation, and therefore the net differences which are there in the translation also will automatically get carried over in my consolidation also in that sense. And Ind AS 110 does not give any exceptions to anyone in that regard. Even extra disclosure saying that for a better presentation, I'm eliminating something like that is not something which is envisaged by 110. So that would be the opinion, or that is the opinion which was finalized by the EAC after a lot of deliberations. And besides this treatment of the exchange differences, there would be a lot of disclosures which can be included, which would be related to Ind AS 110 disclosures, Ind AS 21 disclosures, as well as Ind AS 116 disclosure, which would be included both in the standalone as well as the consolidated financial statements. So maybe Santosh, the other panelist who is there, maybe he has something to add on this, or maybe the moderator.
No, sir, I think you have covered it pretty well. First of all, good evening to all the participants and to Parulji, Debashishji, and Raghavendra. No, I don't have anything further to add, Himanshu sir. Just it's of course a very peculiar case. Not very often that you find an Indian company having functional currency of non-INR. So obviously there is the very typical issue and very interesting and very interesting kind of aspect.
The only thing, Santosh, I was just thinking, of course, not changing the opinion anywhere, but the only thing is, what could be the situations where an Indian company having a subsidiary would be able to have a different functional currency? Though, of course, the standard says that it depends on how your transactions are structured and other things. This is something very, very rare and I think very, very typical of a specific situation or something.
Correct. Absolutely. And we know that Schedule 3 requires the presentation currency to be compulsorily INR. So there is no option of presentation currency, to choose presentation currency. But let's say for a company which has significant exposure to, let's say, USD, export heavy company, or, a kind of a pharma company which is into, export and import, it is, such kind of a situation can arise. But very seldom do we actually see such scenarios. So, yeah.
So that's the beauty of the entire situation, Himanshu sir and Santosh ji, that such complex things comes to us, and as accountants, we weave a magic around it and try to find solutions to those. So as you rightly pointed out, this is one kind of a scenario wherein the subsidiary company has a different functional currency than what its holding has. Moving on to the next opinion, this is again a very interesting issue. The issue is for accounting treatment for upfront advance payment made towards hooking up charges as a part for laying city gas distribution network. So city gas distribution network, as all of us are aware, is picking pace in our country as well now. So the opinion is regarding that. So facts of the case goes as under: the company is in the business of city gas distribution. As part of its operations for laying down city gas distribution network, the company enters into hooking up agreements with natural gas providers. The hooking up facilities, which are called as the identified assets, were created by transporter on receipt of upfront payment from shipper, i.e. the company in the exempt case. As per the hooking up agreement, following modalities were decided. Transporter will construct, install, test, calibrate, and commission metering facility, gas monitoring equipment, pressure regulators, filters, telemetry, and all hooking up facilities in accordance with the requirement of the operating conditions. Hooking up facilities shall be designed to handle the defined maximum value at hooking up point. Gas temperature shall also be defined as per the company's requirement. Transporter shall develop metering facilities as per the requirements of shipper at a defined flow rate or lower as per the requirements of the company, and ramp up the metering facility on shipper's direction based on increased volume plan of the company. Further, the transporter does not hold any substantive substitution rights. Such assets were created for exclusive use of the company, which also possesses rights to control and direct use of identified asset. Can we move on to the next slide? Yes. So prior to introduction of Indian accounting standard, Ind AS 16 leases, the company used to classify this hooking up payments as prepaid expenses under the heading of other non-current asset and was amortizing the same based on the life of the agreement. On introduction of Ind AS 116, based upon discussions with the auditors for the company for the financial year 1920, the company agreed to reclassify the said prepayments prospectively from 1st April 2020. Accordingly, the other carrying amount of hooking up prepayments, as was reflected under the heading other non-current assets, were reclassified to right to use assets in the statement of financial position in accordance with Ind AS 1116 leases. During the audit of accounts of financial year 2021, another team of auditors advised the company to reclassify such prepayments as intangible assets following the provisions of Ind AS 38. Now, the opinion of the EAC has been sought out towards these hooking up agreements on the following points: whether to account for such prepayments as right to use assets as per Ind AS 1116 leases, or to account for such payments as intangible assets under Ind AS 38, or to account for such prepayments as other non-current assets. So our opinion was sought on following 3 points. Now I would request Santosh ji to kindly deliberate on the said opinion and enlighten the audience on this.
Yeah, sure. So basically, this facts is pertaining to applicability of lease. So basically, as you saw in the facts, earlier the company was treating this payment. So the scenario is like this: there is a company which is into distribution of natural gas in the city, and to get the infrastructure in place, the pipelines, the entire infrastructure in place, there is an arrangement with a vendor, with a transporter. The arrangement is such that the company, that is the shipper, it has paid an upfront fees, obviously to enable the vendor to finance and fund the construction. And there are very specific rights by virtue of the agreement. That is, there is the transporter will construct, install, test, calibrate, commission, metering facility. Okay, specific to it is tailor-made for this company, for this shipper. There will be another important fact is that the transporter shall develop metering facilities as per the specific requirements of the shipper at a defined flow rate or lower as per the requirements of the company, and ramp up the metering facility on the shipper's directions based on the increased volume plan of the company. So in short, the arrangement is such that the entire infrastructure has been tailor-made to suit the requirements of this company. So the vendor does not have any substitution right. So it cannot tomorrow say that, I'll cater to a different, customer using the same infrastructure. But if it has to do that, it has to again further build another set of infrastructure. So the question is, obviously, as we all would know, that under Ind AS 116, lease accounting is not just confined to arrangements or agreements which are informed leases, but also it goes beyond the substance over form is there. So even if the arrangement is not called as lease agreement, so for example, if there is a significant, like in this case, it's a hooking, this is a hooking up arrangement. So in this case also, there can very well be lease, either completely or partially. So if one looks at paragraph 9 of Ind AS 116, it requires that at the inception of the contract, an entity shall assess whether the contract is or it contains lease. Okay, a lease is or contains a lease if the contract conveys the right to control the use of an asset, of an identified asset, for a period of time in exchange of consideration. One of the major, the more important terms here is the identified asset. What is an identified asset? So if one looks at the application guidance, an identified asset is a scenario, in short, where the vendor doesn't have any other asset, alternative asset, to cater to the agreement with the customer. So in the current scenario, the company has the rights to hooking up facilities for an initial period of 10 years in exchange of an upfront payment. The hooking up facility is explicitly specified in the agreement, along with the specific location, temperature, pressure, maximum volume, capacity, flow, etc. And it has been exclusively developed as per the requirements of the company, of this shipper. Also, any alteration or modification is required in terms of whether, whenever there is an increase in the flow or, in the volume or capacity or temperature. And then there will be additional cost, so if the company wants the vendor to ramp up the facility, then it has to communicate and the vendor has to ramp up its infrastructure as per the hooking up agreement. Further, substantially, the way the committee looked at it, substantially all the output of the infrastructure is being currently consumed by the company. So it seems that based on the criteria that we have in Ind AS 116, there is an identified asset. The next question is, once you have an identified asset, in order to the arrangement to qualify as a lease, the company should have the right to obtain substantially all the economic benefits from the use of the identified asset. So looking at it from the paragraph, there is this paragraph B21 of Ind AS 116, which looks into this aspect. So in the current case, the company has, an exclusive use of the infrastructure, and it has been tailor-made for the, to suit the requirements of the company. Even if the owner has the right to install or operate or maintain or modify any of the facilities as per the hooking up at the hooking up facility, the vendor will have to take the, it will need the permission of the customer of the company to modify or alter anything. So based on that, there is this criteria of having a right to obtain substantially all of the economic benefits seems to be fulfilled as the committee analyzed it. The last criteria before concluding as to whether or not it is a lease is whether the company has a right to direct the use of the identified asset throughout the period of the use. So again, looking at it from fact pattern point of view, if so the company has the right to direct the use of the infrastructure in place. Although as per the agreement, the company may not have the right to operate the facilities. However, since the facilities have been developed specifically considering the requirements of the company, basis the temperature, the pressure, the flow, the volume, etc., it has been designed to suit the requirements of the company. So therefore, in this case, the way the committee looked at it is even this criteria is met that the company has the right to direct the use of the identified asset throughout the period. So therefore, the conclusion in this case was that there is a lease agreement. The agreement does, contain lease, and therefore the upfront fees that has been paid by the company should be accounted for as a right of use under Ind AS 116. And in this case, because the scope exclusion, Ind AS 116 doesn't deal with certain intangible assets, it would not be appropriate to classify it as an intangible asset under Ind AS 38. So the conclusion in this case was that Ind AS 116 is applicable. Many a times we do come across such agreements where there is a right to use the vendor's asset. A typical, a kind of a common example is that of where a company is using the cars which have been supplied by a vendor. So if there is substitution right, if the the criteria for identified asset is met, okay, which is if the vendor has a large fleet of cars and he can cater to the company using any of the cars which are it's not specifically tailor made for the company, in that case identified asset criteria will not be met. The right to use the asset and to obtain significantly the benefits from the asset, that can be very, very subjective, and the fact pattern, the exact rights that you have in the contract needs to be analyzed very carefully. So again, as I said, although this hooking up facility agreement is not exactly a lease agreement from a legal point of view or from a form point of view, but it qualifies as a lease agreement under Ind AS 116. So, Himanshu sir, you want to add anything or?
No, perfect, Santosh. And as the query has also said, there would be some people who may like to treat this as an intangible asset because that word comes as a right of use or something. I think the issue there is mainly the assets which are constructed by the transporter are mainly tangible assets. So it's a predominant tangible portion which is being looked into. And when you have a predominant tangible portion of that entire asset, there would be a very small portion which is really an intangible, which is a right of use. But then as the Ind AS 38 also says, and also 116 says, if the tangible thing is more predominant, then I cannot use Ind AS 38. I will have to fall back either to Ind AS 16 or this Ind AS 116. In this case, it is taken as a leased asset because of the conditions which are met. And therefore, the cost incurred by the transporter would be considered as a asset and classified as a right of use asset in terms of the terminology which we use in Ind AS 116. And clearly, all conditions are met about using the asset for more than the economic life of the asset. I have a right when and how to use that particular asset. All those conditions are clearly fulfilled, which are there in Ind AS 116.
Right. And typically, Himanshu sir, I would look because there is an upfront payment. Ideally, if the company is substantially funding the vendor, then it would keep the rights to, kind of operate, not if not operate, but substantially use the infrastructure. I think that is one more element that the
Fine. So Raghavendra ji, anything else on this? Maybe if there are some queries which have come for each of this, the first case and the second case, we can consider the queries from the participants also at the same time, rather than go back to the query again and deal with it.
Sir, we have not
I don't
received
think
any
we-
questions. We have not received any questions
Yes.
so far. We will share once we receive the same.
Okay, fine. So then should we go on to the
Okay,
third
so
one,
now,
Raghavendra ji?
yes. Moving on to the third query that we have for today's session. It is regarding presentation of interest payable and depreciation for earlier years in the statement of profit and loss. Now, the facts of the case goes as under. ICI team, if you can just change the slide. Yes, now it is okay. Yeah, so a corporation which is a joint venture of Government of India and Government of National Capital Territory of Delhi proposed implementation of the airport line project on a public partnership model, which we commonly call PPP model. A special purpose vehicle, namely D, the purpose of implementation of the project as per the terms and condition of the concession agreement. It was agreed between D Limited and corporation that all civil works as well as appointment of consultants, land acquisition and other clearances from the government and other authorities have to be obtained by the corporation, and the design, supply, installation, testing, commissioning of various systems like rolling stock, power supply, overhead equipment, signaling, track system, platforms, screen doors, ventilation, architectural finishing, etc. were to be provided by D Limited. As per the terms and concession of the conditions of the concession agreement, D Limited was to operate airport line to the corporation. Commercial operation date of airport line was started on 23/2/2011. This is called as revenue operation date. Before ROD, all capital expenditure incurred by the corporation was accounted for as capital work in progress. And at the time of start of commercial operation, the corporation capitalized the assets of airport line at the cost incurred by it towards civil cost, plus a notional amount of rupee 1 was incurred towards cost incurred by D Limit. On 23rd 5 2012,
is there any IT glitch? I'm not sure if it's mine or Mr. Raghavendra's IT. I think
Yeah, I think there is some network issue at the end of Raghavendra ji. So should I continue with this presentation once his network is stabilized? Maybe he can then continue with this. So I will again go through the facts.
Yeah.
Yeah. So the corporation got the repair works executed, but D Limited claimed that the defects pointed out in the notice were not cured within a period of 90 days, and resulting in an event of default under the concession agreement. and then again issued notice on 8th October 2012 for terminating the concession agreement, and that is with effect from 7th January 2013. Then the corporation claimed that the termination notice issued by the delimited is in violation of the concession agreement and unwarranted, and therefore it invoked arbitration. Meanwhile, after completion of the repair works by the corporation, delimited agreed to restart the line from 22nd January 2013 on behalf of the corporation. And again on 27th June 2013, the concessionaire, that is delimited, served another notice on the corporation conveying inter alia that delimited intends to stop the operations on airport line, that is with effect from 1st July 2013. The board of the corporation decided that the notice given by the concessionaire is in violation of the concession agreement and unwarranted, and decided to take over complete operation and maintenance of the airport line at the risk and cost of delimited in the larger public interest with effect from 1st July 2013. Now on 11th May 2017, I think Raghavendra sir has joined back. Raghavendra sir, would you continue? Would you like to continue with this? We are
Yes,
on.
ma'am. I'll do that, ma'am. Yes.
We
So
had
on
lost you
11
actually
5.
between.
Yes, ma'am. Yes, ma'am. Thank you so much for chipping in. On 11/5/2017, the arbitral tribunal in award concluded that the termination notice issued by D Limited on 8/10/2012 was valid and awarded a total amount of 2,992.49 crore, including termination payment, along with further interest in favor of D Limited. Against the award of arbitral tribunal, the corporation filed a petition in the Delhi High Court, which was dismissed by the learned single judge of the High Court by a judgment dated 6/3/2018. The corporation challenged the judgment of the Honorable of Delhi High Court. The division bench, by judgment dated 15/1/2019, reversed the judgment of the learned single judge and allowed the appeal filed by the corporation. In reply of that, D Limited preferred a SLP before the Honorable Supreme Court of India against the judgment of the Honorable Division Bench of Delhi High Court. The Honorable Supreme Court, via its judgment 9/9/2021, allowed the appeal filed by D Limited and upheld the award of arbitral tribunal and set aside the judgment of the Honorable Division Bench of the Delhi High Court. The corporation filed a review petition with Honorable Supreme Court on 7/10/2021, which was also dismissed by the Honorable Supreme Court via order dated 23rd/11/2021, stating that there is no case for review made out. Accounting treatment in the financial statements of the corporation for the financial year ending 31/3/2022 is as follows. The termination payment been capitalized in the books of account of the corporation with effect from 7 Limited on airport. The company has proposed the following treatment and disclosures in the financial statement for the financial year period up to 31/3/2022, along with the depreciation for the period 7, accordance with capitalized in accordance with paragraph 12 above, is charged to the statement of profit and loss. Proposed accounting treatment which this company has adopted, whether it is correct or not. So first opinion which was sought was whether that proposed accounting treatment which the company has done is correct or not. If not, what is the correct accounting treatment which should be adopted for? Now, this is a very peculiar case which was there. This line which had been built, the airport metro line, was much into limelight. And I remember specifically that due to this court judgment, in many banks' balance sheet, a separate disclosure used to come. So it is a very important issue that all of us must be. I would request Himanshu sir to kindly proceed in the said matter.
Yeah, thank you, Raghavendra ji. This is clearly looks to be the Delhi Metro Airport line, where just like the metro stopping on and off, the cases also were going on and off. So the the company D Limited, which was running that line, and the corporation who was providing the other infrastructure, clearly lot of disputes between them. And D Limited obviously said that some infrastructure was not proper and therefore claimed that 2,900 crores incurred that extra cost or something. The corporation obviously disputed that. Finally, it had to go all the way from the tribunal to the single bench High Court to the division bench High Court, and then on to the Supreme Court, where finally the contention of D Limited that cost should be given to the company was finally accepted by the Supreme Court. Now, in terms of all that, there is a gap between maybe a incurring of that expenditure and accounting for that expenditure finally, which was decided by the Supreme Court. And the issue which has come up is that because of this delay of almost maybe 5 or 6 years in deciding this particular dispute, this amount, whether first of all, can it be taken as an exceptional item? Because that is what the company is contending, that this is a large amount and therefore it can be treated as an exceptional item. And secondly, the query obviously is therefore, in case it is not considered by the EAC as an exceptional item, what would be the right way in accounting for this particular transaction which is there as such? Now, when it comes to deciding whether a transaction is exceptional or not, you are basically referring to Ind AS 1, which talks about presentation of financial statements. And the second thing we have to refer is the Schedule 3, which in the Indian perspective tells you how the presentation has to come in the financial statements, the profit and loss statement and the balance sheet. Coming to the Schedule 3 first, Schedule 3, as you clearly know, mentions that interest and depreciation are separate line items. So in my statement of profit and loss, interest is a separate line item and depreciation is a separate line item. That is something which needs to be considered or taken into account before I decide whether something can even become exceptional or not exceptional. Going back to Ind AS 1, Ind AS 1 does not lay down any format as to how do you prepare your financial statements, how does your profit and loss account, which items you will give and so on. But it says that it would include all items which present revenue for a particular period. It also says that all your line items on revenues as well as expenses which are there, you can add on additional line items, headings and subtotals which are relevant to an understanding of the financial statements. So when I decide how do I present my financial statements, I will have to look at a combination of both. What is my Ind AS minimum requirement and what is my Schedule 3 minimum requirement to comply with the Companies Act disclosure norms which are there. Having said that, the word exceptional is not really defined anywhere, neither in Ind AS 1 nor is it defined in Schedule 3. However, if you look at Ind AS 1, there is a paragraph 98 which says that there are some items which can need or which can warrant a separate disclosure. And they have written down some 5-6 circumstances when a separate disclosure could be warranted of some of those items. And the examples which they have said, there is a write down of inventories to net realizable value or property plant equipment to its recoverable amount, any cost on restructuring of activities or reversals thereof, any major disposals of property, plant, equipment, disposals of investments. If you have discontinued operations, of course, for discontinued, there is another standard also. Any litigation settlements which are there and so on. So that is something which is given by Ind AS 1, not using the word exceptional, but saying that there could be a separate disclosure given of these items. Further, when you look at both Ind AS 1 as well as Schedule 3, there is a concept of materiality. So when I look at materiality, there are two things: whether that information which I need is a minimum requirement which I need to give, and what is the magnitude of that particular item which is there, which I want to disclose. When you come to a word which is exceptional items, we have to see a combination of items which are material, as well as are they frequent in occurrence or incidents which are there, and accordingly decide what is material and not material. Now, in this particular case, after having analyzed Ind AS 1 requirements and having analyzed the provisions of Schedule 3, the committee came to a view that a finance cost is something like an interest cost, or interest is more like a finance cost, and therefore it is in my normal nature of activities of a company. It is not something which is non-recurring or something which is infrequent or something. Secondly, when it comes to depreciation, that is also something which is in the normal course of business. In this particular case, it has been accumulated over the years because of the dispute, but otherwise it has arisen over the years which are there. And because the finance cost and depreciation both are in my day-to-day activity, something in the normal course of my business, though maybe the magnitude could be higher in a particular year because of these circumstances, it still cannot be considered as exceptional or something. So the committee clearly finally concluded that these two items, when I account for it in March 22, they cannot be called exceptional. However, looking to the Ind AS 1 require or paragraph 98, where it says there are certain items which could be significant for which you can give a separate disclosure. So what the committee has suggested is that maybe below your financial statements or as part of the notes of financial statements, you can always disclose that whatever is the finance cost and whatever is the depreciation also includes this significant portion which has arisen on account of the settlement of the litigation which was there, which will help a reader to understand why the magnitude of finance cost and the depreciation suddenly went up in one particular year which is there. And this the company can decide by again doing some disaggregation, giving some headings or subtotals which are possible in terms of Ind AS 1 which is there. So, I mean, to just summarize, the committee, after discussing all this, said these are items in the normal course of business, cannot be considered exceptional, but you can go ahead and give some extra disclosure which is required, which can make the reader more informative or more knowledgeable about why this sudden jump in the magnitude of both finance cost and the depreciation. Santosh, you want to add on something?
No, perfect, sir. I think this classification as exceptional item, I think this is a very useful. This EAC sets the the requirements very clearly. I think in many quarters of in many companies there is a kind of a myth that anything which is as you mentioned in some time back, that if the quantum is high or if it is non-routine in nature, automatically it qualifies as an exceptional kind of a thing. And generally companies come to the auditors when they say that you see something which is very major, very in terms of the quantum, can we classify it as a exceptional, so that it kind of gets you can present it profit before exceptional or after exceptional in a certain way. But I think the way the committee has gone about laying out the principles correctly, I think this is a very useful EAC. We know that EAC opinions are specific to the querist, to the company who's seeking the EAC, but I think this EAC is it sets the principles quite clearly. This is quite useful.
No, clearly so, Santosh. And I think the companies may be well advised in such cases that after this particular item, add a bracket, refer note number so and so, where they can put whatever else they need in this particular case.
Correct.
And companies more come from an analyst point of view that this EBITDA will change, this will change, that will change. But I think that is a separate format which they can use for the analysts, and for this regulatory purpose, they will have to follow this particular format itself.
Correct.
But Raghavendraji, one point which I thought just as an additional point is, when you have so much interest and depreciation loaded onto the asset cost, one thing which the querist or which the company may need to look at is the impairment
Impairment.
provision, because this would really load the asset by a very large amount, though that is not part of the query. I believe this is something which anyone who has such a similar situation will need to look at the impairment of that asset.
Sir, you are absolutely right that impairment testing also needs to be carried out at a regular interval as per the requirement of the standard. That is also one of the very important point that we need to factor in both as an auditee and both as an auditor.
Unless, Himanshu sir,
Sir,
there
we
is
have one question on
a,
query number 2.
Yeah, sorry, please go ahead.
Yes, sir. Yes, Santosh sir, please go ahead, sir.
Unless there is a kind of a rate correction, this being a metro, company, there is a kind of a rate correction that for this also you'll be able to pass on the additional cost to the users. But absolutely correct. I think otherwise it's an impairment indicator.
Fine. Yes, Raghavendra ji.
Sir, we have a point for query number 2. Classification of lease.
Sorry, Raghavendra ji, your voice was slightly breaking. Can you please repeat the query?
Yes, I would repeat, Santosh sir. So the query is in regard to the query number 2 that we just took. So the would substitution rights with the lesser have any impact on classification as lease?
So I'll just make sure I heard you correctly. Would the institution's right with respect to the lessors impact the lease assessment? Is that what the question is?
No, it is
With the
substitution right.
Substitution right does certainly have an important role to play in assessing whether there is an identified asset. So as I mentioned a few minutes back, let's say if there are several assets that the vendor has access to, and he can cater to the customer using any of those assets. So in that case, there is easy substitution right. So, or if it is not impracticable, there are two negatives: not impracticable for the vendor to cater to this agreement by using some substitute, some kind of a replacement asset. In that case, yes, the assessment of whether or not there is any identified asset will be impacted. A very crucial fact pattern there was that there is no substitution rate, meaning that the owner of the infrastructure did not, in theory or in practice, have any other replacement asset or alternative asset through which it can cater to this particular contract. So that is absolutely important. That would affect the criteria for identified asset. I hope that answers it.
Yes, sir, it does. Do we have any more query, Parul ma'am?
No, no relevant query as of now. We'll certainly put up the questions whenever the relevant questions come up. You can go ahead with the presentation, sir.
Yes. Okay. So now let us move on to the next question which we have. This is regarding the accounting treatment of the transactions relating to the billing disbursement in the capacity as central transmission utility. So the facts of the case goes as under. The Ministry of Power, Government of India formed a government company as central transmission utility having the responsibility for the billing, collection and disbursement of transmission charges on behalf of all interstate transmission systems. The company is a wholly owned subsidiary of P Limited to undertake and discharge all the functions of CTU under the Electricity Act 2003 and regulation directions by Central Commission Authority, Central Government. The main functions of the company are enumerated below. Undertaking transactions of electricity through interstate transmission system, planning, coordination and development of interstate transmission system in coordination with various stakeholders, billing, collection and disbursement of interstate transmission system charges, and it also acts as a nodal agency for providing open access related activity, medium term open access activities, long term access as per CERC regulations. It acts as a nodal agency for planning and coordination for development of communication system for ISTS users as well as supervision of communication system in respect of ISTS, installation of interference meters at the points of connection with ISTS. As one of the main functions of CTU is billing, collection and disbursement of ISTS charges as prescribed in the CERC sharing regulation, the company is mandated to raise bills on behalf of ISTS licenses for ISTS charges to the designated interstate customers based on tariff orders issued by CERC on assets owned and operated by respective ISTS licenses, collect the transmission charges from DICs and disburse the same to ISTS licensees as prescribed in CERC sharing regulations. As CERC sharing regulation 2020 permits billing, collection and disbursement of ISTS charges, no separate agency agreement is required for the above said function. The company raises the bill for transmission charges on behalf of ISTS licenses by way of raising invoice to various DICs, clearly mentioning that the company is raising bill for transmission charges on behalf of ISTS licensees. The amount collected from the DICs are disbursed to the licensees without any markup. Presently, on the income side of statement of profit and loss account of the company, the revenue from operation consists of income from application fees on connectivity or long-term open access, medium-term open access charges. The milling made by CTU on behalf of ISTS licensees is shown in the inner column of statement of profit and loss under the head revenue from operation, and the same amount is written on the date of revenue and revenue stream of the company in the form of reimbursement of other operation and maintenance expenses is yet to be notified by CERC. Due to non-receipt of CERC order for reimbursement of O&M expenses, the company has incurred the loss. The bills for the transmission charges, whenever issued to DICs, become recoverable from DICs and payable to ISTSI licensees simultaneously. The balances of recoverable from DICs and payable to licensees are adjusted as and when the payment is received from DICs and disbursed to ISTS licensees separately. Now, the opinion of the EAC is solicited as to whether the accounting treatment presentation made by the company for the transaction relating to billing, collection and disbursement in the capacity as CTU in the statement of profit and loss and balance sheet is appropriate. If not appropriate, what should be the accounting treatment presentation of BCD function in the financial statements of the company? So now I would request Santosh ji to kindly take up this particular opinion and enlighten all the audience on this part.
Sure, Rajendra ji. Thank you. So basically, this query relates to a scenario where there is a CTU. It is rendering billing, collection and disbursement services. It is raising the invoices on the DICs on behalf of the ISTS licensees. So it is not as such on its own involved in any transmission of power, or it is not playing in the role of playing any part in the role of any power transmission, power generation, or any power distribution. This company, this entity has been formed only to do the billing, collection, and disbursement services under the CERC regulations. Currently, based on the facts, again, Raghavendraji, what he read, so just to reiterate, currently the company is presenting the billing that it is doing to the DICs as as an amount in the inner column of the revenue line item, and the amount which it owes to the ISTS licensee holders, whatever is payable, as a deduction from that, and the outer column of the revenue line item in the P&L is nil. So that is why it says there is no financial impact on the overall, based on this presentation. So basically, the company had sought the EAC committee's views on this presentation. So the way so EAC looked at it from the Ind AS perspective. So under Ind AS, if one has to treat any income as revenue, the framework is set by Ind AS 115, which deals with revenue from contracts with customers. One of the essential features of a revenue contract is there should be a contract with the customer. So the committee first looked at it, whether there is a contract between the company and the customer. Under Ind AS 115, a contract can be either oral, it can be written, or implied based on the company's customary business practices. So based on this, the first determination is whether there is a contract between the company and the ISTS licenses or the DICs. In this case, the committee noted that there is no separate written agreement between the company and the ISTS licenses or the DICs. So therefore it seems that it is an implied contract, because the entire BCD services are being rendered by the company under the regulations, under the CERC regulations, and therefore, since it's an act, which is being followed, there is an implied contract. The committee also noted that even if one were to say that, one were to conclude that there is no contract because there is no legal, contract or agreement between the parties. Even in that case, because there is no other standard which deals with, principal versus agency considerations, the company can, or an entity can, apply the principles of Ind AS 115 through the Ind AS 8 hierarchy. As we know that Ind AS 8 states that when there is no specific guidance in any of the accounting standards, any of the Ind AS accounting standards, you can follow the principles of the standard which is the closest to the current situation. So therefore, the framework that the committee used to look into this query was Ind AS 115. Ind AS 115 gives a very elaborate guidance on assessment of principal versus agency. And typically, principal versus agency issues comes in scenario where you are not entirely fulfilling the full thing. So, for example, if I'm buying a good from a vendor and on a back-to-back basis, I'm selling it to a customer. In that case, typically, principal versus agency considerations would arise. I'm not saying that you will always be an agent, but depending on what role you're playing, whether you have pricing discretion, whether you have inventory risk, whether you have the primary responsibility to deliver towards the customers, and in short, whether you control the good or service before you are actually giving it to the customers, those would be the parameters based on which you would assess whether you are a principal or agent. And mind you, this is principal versus agent purely from an accounting standpoint. It has got nothing to do with legal, whether from a legal standpoint or GST or Income Tax Act, whether it's a principal or agency kind of a relationship. Under Ind AS 115, paragraphs B35 right to paragraph B37, B38 deal with principal versus agent guidance. So, as I said, B34A lays down that if the entity controls the good or the service in question before the good has been transferred to the customer, that is a scenario where you are actually acting as a principal. So if I'm not controlling the good or the service before it is being transferred to the customer, in that case, the standard would say that it is basically I'm acting merely as an agent, and therefore I should not book the entire gross revenue. I should only book the, so to say, the commission or the margin that I have, if at all I have, as an agent. So in the extant case, if one looks at it, this company is not itself rendering any, power distribution or power transmission kind of a scenario. It is doing billing, collection and disbursement services. It is a nodal agency for planning and coordination for development and communication system of ISTS users, as well as it supervises the communication system with respect to the ISTS and the installation of the meters, etc. The invoices that this company raises is also on behalf of the ISTS licenses. It is not raising the invoices on its own behalf. That is also very clearly mentioned in the invoices, the sample invoices that the committee cited. The company does not have any pricing discretion, because the pricing is, even for the BCD services, is set in the CERC tariff regulations. Further, as per the CERC regulations, billing, collection and disbursement of ISTS charges, there is no separate agency agreement is required. So there is no separate agency agreement or any other agreement which is required between the ISTS licensee holders and this CTU or this specific company. Another important fact which the committee noted was a clause in the regulation 21 of the CERC sharing regulation, which states that failure on part of a DIC to make payment in full against the bills by the due date under these regulations shall make the DICs liable for action for any or combination of the following by the central transmission utility on behalf of interstate transmission licenses. So whatever rights it has, this company, on default of the payments by the DICs, it would have those rights on behalf of the interstate transmission licenses. So again, that also shows that this company, this entity is acting as an agent. Further, the amounts that are collected from the DICs are disbursed to the ISTS license holders without any markup. So this company doesn't have any markup or any commission that it earns from this activity. Basically, it's an entity which has been formed by the government to do certain specific activities. So overall, the committee concluded that under Ind AS 115, an entity is a principal if it controls the goods or the services before transferring the same to the customers. Conversely, it is an agent if its role is to arrange for another entity to provide for goods or services. So therefore, the company should first assess whether it controls these activities before it's actually transferring these activities to the customers or to DICs. In this case, the billing involved is for the use of the ISTS licenses, The company is basically a central agency which is incorporated under the Electricity Act. It is raising invoices on behalf of the ISTS licenses, collecting monies and disbursing the same to ISTS licenses. So therefore, overall, the committee concluded that in absence of any primary responsibility, pricing discretion, inventory risk, etc., it would not be appropriate to conclude that this company, that is the CTU, is acting as a principal. Rather, from a Ind AS 115 standpoint, it is acting as an agent. Since the company is only acting as an agent and not a principal in respect of billing, collection, and disbursement services, no agency fees or commission is being charged. The committee is of the view that the company should not recognize any revenue pertaining to these services. Also, any related asset and liability which is recoverable from DIC or payable to ISTS licenses should not be separately presented. Rather, the same may be appropriately presented and disclosed by way of notes to accounts. The committee also noted that under Ind AS 1 requirements, there is a requirement that an entity should disclose along with significant accounting policies or other notes wherever there's any judgment or estimates are involved. So therefore, this principal versus agency being a significant area of management judgment, appropriate disclosures of the accounting policies of the arrangement with respect to billing, collection, and disbursement services should be disclosed in the financial statements. So again, to repeat, overall the conclusion was that the amount billed to the DIC should not be presented as a revenue by the company. And since it's merely acting as an agent, it should not recognize the related asset and liability on account of billing, collection, and disbursement services on behalf of ISTS licenses. So that's all on this EAC.
Himanshu sir, any inputs from your side on this?
No, very good analysis and opinion which is given. Clearly, this entity is more like a pass-through. Now, in a pass-through, that principal agent can become very clear, and the stand which the company was taking, that we can present it in maybe a inner column with a deduction and the outer column will still be zero. Now that again is something which this opinion clearly does not allow, and this is what a lot of companies have been doing in the past, that when they want to have this concept of, say, collecting on behalf of someone, something which was followed in a lot of companies was they used to show it in the inner column, show the deduction also in the inner column, outer column would be a net figure, in which in this case is a zero. The same thing was also done in a lot of balance sheets. Now, this opinion clearly demolishes that the practice which a company has been doing, or a lot of companies have been doing in the past. So, the companies in such cases would clearly have to disclose something additional by way of Ind AS 1, rather than putting it as part of my statement of profit and loss and balance sheet, whether in the inner column or the outer column in that sense. So clearly, it again gives a lot of clarity to the whole thing. And frankly, in such cases, in this particular case, the financial statement practically may not have any revenues or any expenses or any asset or liabilities, because it's clearly 100% passed through, collecting everything on behalf of another entity or something.
Sir, one small question from my side. Yeah, Santoshji, please carry on.
No, just to react to what Himanshu sir said, out of recollection, few years back, there used to be practice where some companies used to present revenue including GST or excise duty, and then show excise duty as deduction, and then those kind of presentation, perhaps in Ind AS 115 framework is not possible. Yes, Raghavendra, sorry.
Yeah, so my only query was, as a layman, sir, since we are not accepting the treatment of the company, would it require a prior period adjustment?
That was not specifically sought by the querist. So if it has any material impact on the financial statements, I would have, I would say that there would be a prior period.
But frankly, Santosh, in this case, the outer figures are zero. So
Yeah, exactly.
So maybe
only thing qualitatively, if one
Yeah.
looks at it, yeah.
correct.
Just one more small query on this materiality part of it, sir, out of curiosity. How should the company define its materiality for prior period adjustment? So like materiality for us as an auditors, there is a guiding factor which is available in form of the standard non-auditing.
So
How should the company define its materiality when it decides on the prior period restatement?
So I think materiality is nothing to do with prior period. It's as a whole on the entire financial statements. And now clearly it has a base either on my turnover or on my profitability or asset size. So depending on these three things, which in this case, the company can decide its materiality, but it has nothing to do with a specific thing on prior period itself.
Right.
Right, sir. So before moving on, there is one more query which has come to us. This is on the query number 3, which we took. The query reads as under: the board of directors can give more details with regard to these exceptional items in their report management discussions. Also, if these exceptional costs amount to 50% of the said item of interest or depreciation, even then it cannot be classified as exceptional.
So there are two things which are asked here. One is, can the management disclose this in the report or management analysis? Certainly they can do so, because that is a prerogative of the management to analyze the performance of a company in a particular year. So that certainly they can do. The second point is that that even if it constitutes 50%, can it be shown exceptional? The answer would still remain the same, because magnitude of that figure has nothing to do with whether it is exceptional or not exceptional. Because it clearly, these two items clearly are part of my normal activities of the business. And the committee has consciously taken a view that magnitude would have nothing to do with these items which are there in that sense. The extra disclosures which are given should take care of whatever concerns the company has in someone understanding the financial statements.
Right, sir. So should we move on to the next query? Preeti ma'am, is there any more questions which has come to the previous queries, or else we'll move on to the next question?
Sir, we can move on.
Okay, thank you, ma'am. So the next query is regarding the applicability of Ind AS 108. This is on operating segments on Section 25 companies of the Companies Act 1956, now Section 8 of the Companies Act 2013. A corporation is a central public sector undertaking wholly owned by the Government of India under the Administrative Ministry of Social Justice and Empowerment, and is registered under Section 25 of Companies Act 1956, which is now Section 8 of the Companies Act. The corporation manufactures as well as outsources various aids and appliances such as tricycle, wheels, chairs, motorized tricycle, hearing aids, artificial limbs, calipers, crutches, walking sticks, spectacles, dentures for persons with disability and old age pension. The corporation is the nodal agency for the senior citizen scheme of the Ministry of Social Justice and Empowerment, and also receives grant in aid under the Assistance to Disabled Persons scheme of the Ministry of Social Justice and Empowerment. The major portion of turnover of the corporation is against government grant, i.e. approximately 70% from ADIP and Senior Citizen Scheme of Government of India. Further, 20 to 20% of turnover depends upon the order of state government, central public sector enterprises, National Institute. Rest 5 to 10% of the turnover occurs through cash sale through tender, through dealer. The corporation operates on pan-India basis. The corporation is established by Government of India as not for profit making. It is not in any type of business but welfare of persons with disabilities and senior citizen. Since the objective of the corporation is only social welfare of needy and poor person with disabilities and senior citizen, profit generation is not part of its object. Statutory auditor raised the point that corporation is not preparing operating segment report as per Ind AS 108. The management of the corporation is of the view that Ind AS 108 operating segment is not applicable on the corporation as it is not carrying on any type of business whose nature and financial effects are required to be disclosed. The corporation is engaged in manufacture and distribution of rehabilitation aids and appliances to and senior citizens, and the operation is on pan-India basis. The corporation, on the principle approved from its administrative industry, conducts assessment camp on pan-India basis and then ensures the distribution by sending its team and material to the site. The materials can go to the site from any of the manufacturing units or from its marketing offices. The marketing offices also use the material to stock transfer from manufacturing plants. Thus, the corporation considered itself to be operating in a single segment. What the query was sought was regarding the applicability of Ind AS 108 operating segment on the corporation, and if applicable, on the method of presenting such data considering the nature of operation of the corporation as per the requirement of Ind AS 108. So now I would request Himanshu ji to kindly dwell upon this opinion.
Yeah, thank you, Ravindra. This facts of the case, a particular entity, which is a Section 8 company, works primarily on behalf of the ministry in providing equipments, which are various sorts of equipments to persons with disability and senior citizen persons. So it's a non-profit organization. So the query is basically two or threefold. One is, if the entity is a Section 8 entity, first of all, does this standard apply to me? Does Ind AS 108 apply to me? Second is, if 108 applies to me, is there a separate operating segment for me? And if there is a separate operating segment, how do I give the disclosures which are necessary as per 108? So these are the three queries in that logical order which come out from the facts of the case. So coming to the first thing, whether Ind AS 108 applies to this particular entity. Now, if you look at the Companies Act and you look at the applicability of accounting standards, whether it is the old standards or the new Ind AS standards which are there, Section 133 clearly lays down that all companies who are falling under Companies Act have to follow accounting standards. A Section 8 company is also a company which falls under the Companies Act, and therefore there is no exception carved out in that Section 133 that a Section 8 company need not follow some of the accounting standards. So clearly, even a Section 8 company will have to follow all the accounting standards which become applicable to that particular entity. So that's the first thing. So the entity will have to evaluate whether 108 applies, and if it applies, how does it go about doing that particular disclosure? If you therefore go to Ind AS 108, you have to basically decide whether I am earning my revenues and incurring my expenses in such a way that the chief operating decision maker, that is a concept used in the standard CODM, chief operating decision maker, is he able to monitor, or does he monitor the entity for those revenues and expenses for these various items which the entity deals in? So in other words, whoever is running the whole show, whoever is maybe the CEO or the managing director of this entity, does he monitor each of these items separately for my revenues, expenses and results? Or does he manage the whole thing entirely as equipments which are provided to my persons with disability and senior citizens? Now, apparently that answer is not available in the facts of the case. But if you analyze or maybe try and understand what similar entities would do, at least I have not come across any entity which monitors equipments for such persons separately. So for equipment X, what is my margin? For equipment Y, what is my margin? It is typically taken together for all my equipments which are there, which I give to these persons or the senior citizens which are there. And that is exactly what India's 108 says when it comes to this chief operating decision maker. What are the reports which he uses to decide whether there are separate reportable segments or non-separate reportable segments? So the EAC therefore said that you have to look at these parameters. What is the internal reporting mechanism of the entity which is there, and then decide whether in 108 does it become a segment which will be a operating segment for the entity. And therefore, the answer is not either yes or no. It only says 108 is applicable, but the corporation should first identify whether there are any operating segments. If so, then it can decide further whether it becomes a reportable segment or it remains a non-reportable segment. Now, irrespective of that, even if it is not becoming a operating segment per se, there are some geographical segment disclosures which are required, and also a disclosure whether what are your major customers. So even if you don't have a separate operating segment, you may still need to go and say that these are my geographical segments or this is my single major customer which is there. And in terms of the facts of the case, you have that a lot of sales are done through the ministry or something. Now, maybe that's a major customer which this particular entity could have. So, though there are no separate reportable segments as far as 108 is concerned, this extra disclosure in para 34 about major customers may still need to be given by this particular entity. So, I mean, just to summarize, 108 applies because all standards apply to even Section 8 companies. To decide whether there is an operating segment and a reportable segment, the chief operating decision maker will have to decide what are the internal reports which he takes, the MIS which he takes. If he is doing this for separate items within his broad activity, then there would be reportable segments and all disclosures apply. Even if it does not become an operating segment which is reportable, you may still need to disclose something about geographical segmentation and also about all my major customers who is there. And major customers means anyone who from whom I get more than 10% revenues. And from the facts, I think the direct public is only 5 to 10%. Everyone else can actually become a major customer because I get it through my government ministries and others who are there. So that is how the whole opinion was analyzed and answered by the EAC.
Santoshji, any thoughts from your side on this particular opinion?
No, of course, nothing further to add. But I think that reminder which the committee gave that, the entity-wide disclosures needs to be still given, even if you don't have separate segments. Himanshu sir, I think that's useful because I think sometime back, I think if FRRB also keeps pointing out that point that it's not that if you have just one segment, then entire 108 is not applicable. I think that is a good reminder, I think.
Yes, because ultimately the sign of good financial statement is proper depiction of figure, the truth and fairness of the figures that we are coming out, along with the disclosures that are required. So both the things play a crucial role in shaping the correct financial statements of any company.
I think I can also add that in such cases, no, the entity will need to write in their initial list of statement on accounting policies that the company is operating in a single segment or something. Because in a lot of cases, we have seen that entities who say that they don't have to follow Ind AS 108, they don't even write that they are operating in a single segment or something. So at least that disclosure is certainly required in SAI, in the significant accounting policies.
Let us move on to the last opinion for the day. This is again on classification of lease receivables. So the facts of the case goes as under, which is visible on your screens as well. A corporation which is a public sector undertaking under the administrative control of Ministry of Railways. The corporation was set up as a dedicated financing arm of the Indian Railways for mobilizing funds from domestic as well as overseas capital markets. It is also registered as systematically important non-deposit taking NBFC company and infrastructure finance company as per the definitions of Reserve Bank of India. The primary objective of the corporation is to meet the predominant portion of extra budgetary resources requirement of the Indian Railways through market borrowings at the most competitive rates and terms. The company's principal business, therefore, is to borrow funds from the Indian financial markets for acquisition creation of assets, which are then leased out to the Indian Railways under finance lease agreements. The corporation, in accordance with Ind AS 17, Ind AS 116, read with Division 3 to Schedule 3 to the Companies Act, has been presenting lease receivables from Ministry of Railways as part of receivables on the face of its balance sheet. The auditor observed that in accordance with Division 3 to the Schedule 3 to the Companies Act 2013, the said receivable should be presented as loans rather than receivable. So what the company currently has done is that they have shown it as receivables, whereas the auditors were of the view that it should come as a loan. Now, what was the company's submission? It is said that the company is understood as observed by auditor also that Division 3 of Schedule 3 to the Companies Act 13 requires leasing to be presented as part of loans on the asset side of the balance sheet. The corporation believed that it is primarily a leasing company and not a loan company. Loan was a very small portfolio and leasing was the major portfolio. If the lease receivable is presented as part of loans, it would prima facie appear to the general investor that the company is a loan company. Therefore, in the firm opinion and judgment of the company, the presentation of lease receivable as part of receivable on the face of the balance sheet complies in all material respect with all the Indian accounting standards. Now, the EAC was approached to give the opinion on the following points. Whether the presentation of lease receivable as part of receivable on the face of company's balance sheet is in accordance with applicable Ind AS's read with Division 3 to Schedule 3 to the Companies Act. If not, what is the correct accounting treatment? So now I would again request Santosh ji to kindly come and give us knowledge about this particular opinion.
Yeah, sure, Raghavendra ji. Thank you. So basically, the first point here is that this company is an NBFC. This is clearly stated in the facts. So as an NBFC, it would be, and it is under Ind AS, and therefore the regulation that will be applicable to this company will be Division 3 of Schedule 3, which deals with Ind AS compliant NBFC companies. Under this, as also the querist has himself also admitted that under Division 3 of Schedule 3 to Companies Act, there is a specific requirement to present financial assets relating to leasing, that is lease receivables under loans, under the broader head of financial assets on the face of the balance sheet. The guidance note on Division 3, we know that there are separate guidance notes from the Institute on Division 1, 2, and 3. So this guidance note on Division 3 states that the presentation and disclosure requirements of Ind AS 116 are in addition to the requirements of this Division 3 to Schedule 3, and therefore those disclosures requirements need to be in any case be complied with. But the presentation requirements would be the ones which are prescribed in Division 3 of Schedule 3. Further, Schedule 3 as well as Ind AS 107. Ind AS 107 deals with the disclosure and presentation requirements of financial instruments. Neither Schedule 3 nor Ind AS 107 specify any other requirements with respect to presentation of lease receivables. Of course, under Ind AS 116, there will be many disclosure requirements of the investments in the lease receivables, etc. Therefore, the disclosure of lease receivables under loans as per the Schedule 3 requirements cannot be considered to be in contradiction to or in as departure from the requirements of Ind AS. So therefore, in this case, the committee was of the view that the company should present lease receivables under loans as per the requirements of Division 3 of Schedule 3. On the question of the company being a leasing company and not a lending company, and therefore it not being a very proper disclosure, the committee was of the view that as far as the nature of the company is concerned, the company's primary business is to borrow funds from financial markets for acquisition or creation of assets, which are then leased out to the Indian Railways under the finance lease arrangement. So I'm borrowing funds from market and I'm buying assets and I'm leasing it out to Indian Railways. Therefore, in substance, the company is providing finance to Indian Railways for acquisition or construction of assets. Considering this nature, the committee was of the view that it is appropriate that the lease receivables will be presented under loans rather than receivables, because leasing is another form of financing in a way. So therefore, overall, the conclusion was that the lease receivables cannot be presented as a part of receivables, but it should be presented under loans as per the requirements of Division 3 of Schedule 3. As the auditor of the company had contended.
Himanshu sir, any views from your side? Any more point that you want to add on to this particular deliberation?
No, this is another classic case where a company says that I would like to follow my business related disclosure rather than what is regulated in that sense. Again, as the opinion has fortified that you cannot decide your business related thing when you are coming to regulatory disclosures, because in case the company decides to show it in a separate way, it is non-compliance of the Companies Act, and therefore the company can face whatever action, but even the auditor will have to write in his report that some particular disclosure is not done as required under the Schedule 3 which is there. Having said that, since this is a NBFC, RBI also mandates a lot of extra disclosures for NBFCs. And this particular point which the company wants to show to the outsiders that it is not a loan company but a leasing company can be very well brought out over there. Because there are a lot of extra disclosures which RBI wants for all the NBFCs which are there, which are beyond Schedule 3 disclosures in that sense. So both the things can be captured in that sense, and maybe along with loans, the company can do a cross-reference to those additional disclosures under the NBA or RBI requirements.
I welcome our very dynamic Vice Chairman of Expert Advisory Committee, CA Piyush Chhajarji, who has been giving his invaluable contributions as a council member in the various functions that he's taking forward.
Thank you very much. Thank you. Please continue.
Parul ma'am, do we have any queries?
No relevant questions as of now. We have already covered all the questions that were relevant. Thank you.
Okay. So I think we have covered all the 6 queries that were there for the webinar today. The idea basically, as Chairman sir in his opening remarks also deliberated, that is to disseminate information about the queries that we are receiving at the EAC level, so that the quality of reporting both at the company level and both at the auditor level improves, and that idea of a perfect reporting is achieved. So with this, I would like to hand over the session back to Parul ma'am. We have been fortunate enough to be in time, and we are giving you back in time, meeting the 2 hours deadlines. With sufficient time for the vote of thanks also to be delivered.
Thank you, sir. And now I request our Vice Chairman, Expert Advisory Committee, CA Piyush Chhajarji, to give vote of thanks and concluding remarks. Thank you, sir. Over to you.
Thank you very much. Thank you very much. Very good evening to all the participants who are online, who are also watching us on our YouTube channel. Thank you very much to the panelists for today, Himanshu Krishnadwala ji, Santosh Malar ji, and moderator Raghavendra Goyal ji. All the participants, as you are aware, possibly this year, we had made a plan. I know Chairman would have briefed in his initial opening remarks. This year, we had made a plan that expert advisory committee should debate, discuss about the opinions which have been issued by expert advisory committees. These opinions are sought by various corporates, including PSUs, private limited companies, limited listed entities, and also sometimes by ministries. They seek opinion from an expert advisory committee on the applicability of accounting standards, implementation of accounting standards, Ind AS, etc. And therefore, we had thought, let us do such type of discussions wherein just by reading a opinion you may not actually know what has gone behind this when this opinion was formed. And the idea behind such webinars was that what is the logic behind developing such an opinion actually comes out, and that's why we are doing this opinion. I think so for this particular council period, as you all may be aware, that generally there is a changeover of the committee which happens on 12th of February, and this would be possibly one of our last webinar. This year we have done the record webinars with the support of all our co-opted members who have acted moderators and who have been panelists, and also the experts who are in the field of India's, who have always been available to expert advisory committee and has given their time, their valuable inputs for the benefit of this committee and the participants as such. So there, I would thank you very much, both the experts once again, Himanshuji and Santoshji, and also the moderator Raghavendraji. My small request to all the participants who are present and who would be listening to it or may look into it after who may actually also listen after maybe a recorded message. The idea behind, as I said earlier, is to get more clarity on what the thought process has gone while developing an opinion. If you read an opinion, if you would have read an opinion, I would say earlier, before listening to the experts, these opinions, there would be some doubts. But if you now read it, what has been discussed today, and if you go back home and if you read the opinion today, I think so it will make more doubts cleared that what was the logic behind. So I always request my participants that after listening to the experts, you should actually read line by line opinion. That will clear. I know a lot of participants would be not actually using India's. There would be a participants who are across India, and in day-to-day life they would be also using accounting standards, whereas opinions which are been discussed are on India's. But it is not important what opinion is discussed, which India's has been discussed, but it is more important is how the thought process goes into it. So when you are actually applying even an accounting standard, a similar thought process, similar discussion could take place. So that's an idea behind it. Uh, for this year, our expert advisory committee would be doing, I think so. We have a meeting tomorrow, and I would like to know tell the participants also. This year, expert advisory committee may cross the landmark number of opinions been issued ever in the history of Institute of Chartered Accountants of India. If by tomorrow's meeting, and if we are able to clear all the opinions in the meeting, then there would be a landmark whereby number of opinions ever in a particular committee all the previous landmarks. So I will just take this opportunity to brief all the participants. Thank you once again. A very good evening to all of you. Have a good day. Thank you very much. So tag team, I think. Yes. I think so we can end this session. Tag team, I would request Himanshu bhai. Thank you.
Yeah, thank you.
Stopped, I believe. Thank you.
Thank you.
Thank you. Thank you once again.
Yeah. Thank you.
Thank you. Thank you, everyone.
Thank you. Thank you, everyone.